For most of the year, this market has been led by the Magnificent Seven: Apple, Alphabet, Amazon, Meta Platforms, Microsoft, Nvidia, and Tesla. While the rally's broadened out over the last couple of months, these seven stocks are still huge winners. They're up anywhere from 40% to 214% for the year. But now we've entered earnings season, and it's time for these companies to justify these monster moves in their stocks. Just like the movie, not all of them survive. So far, we've heard from Tesla, Microsoft, Alphabet, and Meta Platforms, and they've been what I call a mixed bag, with Meta standing head and shoulders above the rest. Tesla kicked things off last Wednesday, and while the headline numbers were good, there were plenty of hair on the quarter. Tesla's earnings beat was fueled by non-operating items like gains for foreign exchange hedges. Management said their third quarter production would be down a little bit, even as they reaffirmed their full-year forecast. Just got to trust that they make up that production in the fourth quarter. Their free cash flow came in much weaker than expected for the third straight quarter, and Wall Street didn't love it when Elon Musk talked about spending well over $1 billion on supercomputers to fuel his autonomous driving ambitions. I believe in Musk, but Wall Street's gotten skeptical, which is why the stock tumbled 10% last Thursday. The way I see it, this is a buying opportunity, even as the quarter wasn't exactly a thing of beauty. Next up, this Tuesday, we heard from Alphabet and Microsoft after the close. Well, I think they had a lot of similarities. The market loved Alphabet and loathed Microsoft. Both companies delivered nice top and bottom line beats, though. Both companies delivered solid results for their cloud infrastructure division. Microsoft's Azure was up 26%, and the much smaller Google Cloud up 28%. Both talked about their AI capabilities. I liked it, while also warning that bulking up in the AI business will be very expensive. But in the end, Alphabet stock roared nearly 6% yesterday, while Microsoft stock sold off nearly 4%, and it's still going lower. Why? Okay, the biggest positive surprise for Alphabet was actually from their advertising business. After being down and out for the past year, Google's search finally saw accelerating growth. And what I have to tell you, management also called the stabilization of the YouTube ad business. That was a shocker to me. Alphabet's more or less an advertising place, so if that batter business has bottomed, it makes a huge difference. I've got to tell you, I signed up today for the NFL, the football package on Google and on YouTube, and I find myself saying, well, I think a lot of people play fantasy. I think it's going to be a home run for them. Now, Microsoft's a software company. They didn't get a big boost from advertising. At the same time, Wall Street doesn't seem to like their AI talk. The bears think Microsoft's too vague about the potential benefits of AI, while being very specific about the high cost of getting there. Now, look, Microsoft recently announced pricing for the company's new Copilot AI assistant for Microsoft 365 products, but they wouldn't commit to a launch date for Copilot, with CFO Amy Hood saying only that we probably wouldn't see the benefits from this business until the second half of the company's 2024 fiscal year. That's the first half of the 2024 calendar year. At the same time, Microsoft made it clear that their margins would likely be flat in 2024, thanks to all the AI spending, and that's what crushed the stock. I think they were way too negative. Of course, as I told members of the CNBC Investing Club, I think the pullback in Microsoft represents a true buying opportunity, while you might want to sell part of your position outbid into the stock's recent strength, and for me, some concerns about antitrust. For my money, the best quarter we got from the Magnificent Seven so far was from Meta Platforms, which delivered a blowout set of numbers last night. If the market hadn't turned down today, you would have seen the stock up huge. Like Alphabet, this is an ad-based business, which is how Meta could have an 11% revenue growth this quarter, up from 2.6% in the first quarter. What an acceleration that is. First time they've had double-digit revenue growth since 2021. Even better, Meta's guiding for 15.5% to 24.5% revenue growth in the current quarter, and that is huge. The business benefited from the improved ad market like Alphabet, along with many more company-specific catalysts: higher engagement, more time spent on Meta's family of applications, and the use of artificial intelligence, which led to a 34% increase in the total number of ad impressions in the quarter. All these companies love to talk about AI, but I'd argue that Meta is the one that's seeing the biggest tangible benefit from this technology. And I knew he was working closely with Jensen Huang on this stuff, and I told you that, because they're using artificial intelligence to overcome Apple's privacy restrictions. That allows them to provide better targeted ads on Facebook and Instagram. This time, they also explain how AI-recommended posts from accounts that you don't follow has become the fastest growing category of content for Facebook's feed, hence the big increase in user engagement. And that's where I think NVIDIA is really helping them on. We're seeing something similar at Reels, Meta's TikTok killer, which now has an annual revenue rate of $10 billion. That's up from around $3 billion just last fall. That is a much faster adoption than anyone was looking for. And I'm a huge Reels fan, and I didn't think they could do that. What makes this quarter so remarkable is Meta seeing tremendous revenue growth at the same time that CEO Mark Chainsaw Zuckerberg continues to put through draconian cost cuts. And that includes laying off roughly a quarter of the workforce. That's how Meta could put up a 7-cent earnings beat off a 291 basis. And that number would have been even higher if not for a one-time $780 million restructuring charge. The free cash flow came in at nearly $11 billion. Wall Street was only looking for $6.05 billion. Now, of course, Meta's still doing lots of investing. They're putting a ton of money into this metaverse, which continues to just hemorrhage cash. But while investors might not love that, it's a lot easier to look past those expensive investments when the core business is printing money again. Most important, Meta gave you a terrific forecast. They're talking about roughly 20% revenue growth at the midpoint of their guidance. They cut their full-year capital expenditure guidance by $3 billion, although that's mostly due to a push out of some investments until next year. Now, a lot of people gave up on this stock when it was getting obliterated last year, but those who stuck with it, like we did for my Travel Trust, continue to be rewarded. Shares up 4.4% today, even as the major averages sputtered. And I got to tell you, this stock again was up much more at one point. Meta's now rallied 159% year to date, and it's up 254% from its lows set last November. There's still a long way to go until the stock's bumping up again. It's $384 all-time high from September 2021. But with a couple more quarters like this one that we got last night, it might get there sooner rather than later. Let me give you the bottom line here. At the halfway point of the Magnificent Seven earnings calendar, we've got a bit of a mixed bag. Although I like Tesla and Microsoft, Wall Street certainly didn't like those quarters, while Alphabet and Meta gave you clear wins. That said, so far, Meta's delivered the best quarter by far in this group, and I bet the stock still has a lot more upside, given its still incredibly low valuation versus its growth rate, and a realization that someday soon maybe, the metaverse won't continue to burn through cash as it has been and is supposed to do in the near future. Let's go to Chris in D.C. Chris.
Jim, how's it going?
Well, Chris, I don't know. I didn't like the reversal late in the day. It's got me a little concerned, but let's see what happens tomorrow. How about you?
I'm doing great. So
right.
I have a 401k that I'm converting over to a Roth IRA.
Right.
And I'm looking at a particular stock that's almost tripled over the last 5 years. I'm curious what you think about Palo Alto Networks.
I think you're fine. There was a downgrade today about Palo Alto from, I believe, OPCO, saying it's moved up too far too fast. Well, you know what? That's the kind of thing that says to me, all right, let it come in and buy a little more. So what I'm going to tell you to do is let it come in and buy a little more. Let's go to Jaden in Arizona. Jaden.
Hey, Cramer, how's it going?
Not bad, Jaden. How about you?
I'm doing terrific. Thank you for having me on the show. I'm very excited to be here.
Thank you.
I got a quick question here for you. I'm looking at Apps Digital Turbine, and I've had this position for a while. I'm either looking at it right now as either a buying opportunity or I could wait a little bit while to have it go down a little to maybe buy more. What are your thoughts?
Okay. I'm going to come out against that one because I just think that there is, I mean, it's low valued, but I don't think it has enough growth, and it's down 32% for the year. In a year that's very good, that's very disconcerting to me. Let's hold off on that. I don't think it might be the right thing for you. All right, now we've had a mixed bag so far from the members of the Magnificent Seven that have reported earnings, with Meta being the standout from the group up to this point. Much more Meta money, including my suits with AGCO. Trying to wrap your head around the farm and ag business standing across the globe, well, there's no better place to go than AGCO. I'm seeing some headwinds that are shaking out in the farming sector with the company's top brass. Then there's sight, and then there's hindsight. One will help you make money, and the other could derail your investing strategy. I'm sharing why this lesson is even more important during earnings season than ever. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.